This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Eric, it was great to have Michael back on the show. Now let's get to that chart deck. Listeners, you're going to find the download link for the post-game chart deck in your Research Roundup email. If you don't have a Research Roundup email, that means you have not yet registered at macrovoices.com. Just go to our homepage, macrovoices.com, and click on the red button over Michael's picture saying, looking for the downloads. Okay, Eric, let's start off with your thoughts on the equity markets.
The S&P bounced nicely off support of the 200-day moving average, but while Wednesday looked like a reversal candle in many ways, we still failed to close above any of the short-term moving averages. So technically speaking, the short-term trend is still down until we get a daily close above 58.75 or so. A daily close below the prior lows around 57.50 would suggest that we could be just beginning a much deeper correction. So I'd say it's make or break time for the stock market, and we ought to find out fairly soon which way it's headed. Now again, the signals to watch are for a daily close above 58.75 or below 57.50. Now I know that big 75-point spread between those two levels sounds like a very wide margin, but with the short-term moving averages pointed down and the 200-day moving average pointed up, it will only be a few more sessions before those key support and resistance levels start to converge. At that point, we'll have to see the market break in one direction or the other.
Eric, I agree with your technical levels. It's going to be critical to see whether the bulls can turn this off at these key levels. We're sitting or approaching a lot of key Fibonacci levels as well that typically would spur on a market bounce. But at least as of this moment, we have yet to see the buy on dip traders follow through in any meaningful way. Every bounce is immediately faded. Now, we do have the jobs numbers coming out on Friday morning, and maybe that becomes the catalyst that either spurs the markets higher or really creates a continuation pattern to the downside. And so we'll see what comes of there. But there's some underpinning things that I want to highlight. On page 3, I have the chart of the Magnificent Seven. And what we are clearly seeing is sector rotation. That we continue to see all of these Mag 7 stocks selling pretty aggressively, and that money being redistributed in a number of different sectors. Healthcare particularly doing well. A lot of consumer staples doing well. But these Mag 7s are a huge weighting in the market cap weighted S&P. It's very difficult to imagine a scenario where the S&P has any big meaningful rally without the Mag 7s putting in short-term lows and starting to turn. And there's really just no sign of that at the moment. So on page 4, I have that S&P 500 percentage of stocks above their 50-day moving averages, just a measure of the breadth of the market. And my argument has always been if the Mag 7s can't drive the rally, then you need a broad rally where the vast majority of stocks are rising. And so we'd need to see breadth increasing. And so instead, though, we have a breakdown of breadth. Not only during this January-February period have we not been able to get above 60% of stocks rising, but we're clearly rolled over and turning down. This is happening at the same time as things like the Russell 2000 small cap index is breaking lower lows. And so the breadth of the market isn't there either. This is not a healthy market environment. And even though bottoms can sometimes happen from these kind of oversold levels, there simply isn't a really oversold condition that says that this is imminent any day. If we continue to have news flow that comes out there that creates confusion amongst traders and uncertainty, there's every opportunity this market sell-off to get much deeper. And so that brings the question of, well, should one insure their portfolios? And it's something that we do quite actively at Big Picture Trading, buying all sorts of options to hedge out downside risk. But on page 5, I have that volatility index, the VIX, and this is a measure of the volatility premium that is being charged in options. Now, the market is in theory right pricing volatility, and so with us at these elevated 23, 24 levels, the implied ranges, daily ranges, are even close to in the 50 to 100 S&P point ranges. So huge swings in the market are there, and this makes option premiums more rich. And so, how does one go about hedging when options are more expensive? Well, this is where you can still put on tactical debit spreads and other things that are far more volatility neutral, that allow you to have some degree of protection in this period of uncertainty. All right, let's move on to that dollar.
Wednesday's close below 104 on the June Dixie contract confirmed that we're in a new short-term downtrend on the Dixie. But this is all politically driven, so changing news flow could change the trend in a heartbeat.
Yeah, on page 6, I have that U.S. dollar index, and what a 3-day drop. It really was driven, though, by simply the euro and the pound sterling, the European currencies. We're not seeing the same type of velocity in the other cross currencies. And so really that spurt higher in the euro has driven this drop. We're at this critical 104 level. And while one can argue that this breakdown is a trend changer, and it certainly has that possibility, we are at a really important moment where if the bulls were going to save it, they would need to see a rally that recovers much of the prior sell-off back to like 106 or 107 in a very short order. If we see that all rally attempts stall out at 105 and are very heavy, then really there becomes increasing confirmation that the U.S. dollar has some deeper sell cycle ahead of it that may send it right back down to September, October lows near 100. I'm going to really want to size up the price action in the next 2-3 trading sessions to really size this up. All right, Eric, let's talk oil.
The key technical levels have all been taken out to the downside, so the question now is how low can oil go? Wednesday's low on WTI at 65.20 was almost an exact match of the intraday low on September 9th, 2024. To find a lower low, you'd have to go all the way back to May 3rd of 2023, when WTI very briefly tested 63.65 on a crazy intraday swing, but wound up closing much higher on that day at about 68.15, $5 higher. So as far as any kind of closing print or lower price action, it's been several years since we've seen prices as low as they were on Wednesday. But as Michael Every said in the feature interview, this has been one of those weeks where decades happen, so anything is possible from here.
Well, Eric, we are at 52-week lows, but they are long major lows. So on page 7, when we have that chart, you can see all of the lows that oil established here over the last 6 months. And this could still act as a support line. But when a support line like this is tested this often, there is sometimes a period where the market breaks to lower lows, often hitting a whole series of stop losses and other things, just sitting below that previous support line. If we see a further breakdown, we could see a quick washout to like $63, $62 on the downside, but we are already quite oversold. And I think that at some point, a reactionary rally, at least back to 70 to 72, would be normal. At this stage, with us being down here, I don't want to already be betting on that reversal just yet. I think that a quick washout of even another $2-3 is entirely on the table before we get some proper reactionary bounce. All right, Eric, let's move on to gold.
Patrick, it's really remarkable to see just how quickly all the dips are being bought in gold. And that's true in all different time frames, short term, medium term, even long term. Now, that's a really bullish long term signal. We were hopelessly overbought on a technical basis a few weeks ago, and the swing correction that we just experienced shook that off, setting up a new rally. And we've never even got below the 34-day moving average, which so far has marked the bottom of this correction. The 38.2% fib retracement level was at 28.24, and so far the bottom of this correction was $20 above that level at 28.44. The stage appears to now be set to test 3,000, with the daily RSI still below half-mast at 44 and pointed sharply up as of Wednesday's close.
Well, Eric, definitely gold has been bought on dip, and we do get these bullish reactions to the upside, but we still haven't yet broken to a higher high. And so with us in this consolidation, often like you think back to like April or May of last year, gold will go and retest highs and then consolidate back down to lows and stay within a consolidation period or trade range. At this stage, with us having more or less tested the 3,000 level, and while we didn't print it exactly, we approached it. This is an area where gold has fulfilled its upside targets for the last impulse. And so I'm still open to the idea that this is going to be a consolidation period for gold. Now, the one argument you can make for gold is that with this potential US dollar breakdown, that could become a new tailwind for gold rising. And if that continues to emerge and we see a breakout to a fresh new 52-week high, that could see a move measure up all the way up to 32 to 3,300 on the upside. Will we see that breakout? At this moment, I still want to see how the dust settles here for this short-term trade range that we're establishing as we approach the previous highs. And we'll see over the next week or two whether the bulls have enough gas in the tank to really get this going. All right, Eric, let's move on to uranium. What are your thoughts here?
Well, it's been yet another week of extremely bullish nuclear news flow and yet another week of new cycle lows on spot uranium and uranium mining shares. There's no doubt in my mind that what we're seeing here is the process of retail capitulation, the well-known tradition of the dumb money selling to the smart money right around market bottoms. The obvious question is whether it's over yet, and nobody knows the answer for sure. My take is that given the extreme oversold RSI and plenty of signs of capitulation in the tape action, there's a good chance that the cycle bottom might be in this week if and only if the broader equity market correction is also over and the S&P moves above its short-term moving averages to mark a new short-term uptrend. But if we see the S&P break and close well below its prior lows around 5750, then all bets are off, and lower numbers on uranium and uranium miners would be a near certainty in that scenario. I continued to buy the dips this week, and I'll continue buying more if we see new lower lows.
Well, Eric, uranium is still very actively distributed. If someone keeps leaning into that bid, and it is seeing some distinct distribution. So at this juncture, with these lower highs and lower lows, I want to see where the selling subsides, where we see bottoming formations, where the momentum shifts. None of those things are yet evident. At some point, this is going to be a compelling buy on dip opportunity. But the question is, does one buy it on price alone, or does one wait till the price action starts to shift to show that new accumulation is underway? And that, as of this moment, you may have a very cheap price, but there is very little sign that a new wave of accumulation or new trend is anywhere underway. Finally, Eric, I wanted to just touch on copper. And when we take a look at this chart, it was consolidating over the last couple of weeks back down toward its 50-day moving average, down towards $4.50. And we had a very bullish breakout the other day. And with this breakout, it is attempting to break the February highs and set in motion a trend continuation. What I really want to just see is whether the bulls can hold the gains. Often, if these are fake outs, then this will fade right back to $4.50 within a couple trading sessions. If the bulls can keep this, let's say, north of 465, 470 on all little pullbacks, and the price action goes for another break to new highs, that could go back to testing the May highs that just above $5 on the copper price.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.